Corporate venture capital has a reputation problem. Founders worry about strategic agendas, slow decision-making, conflicts with the parent company, and deals dying in committee. And honestly, those concerns are kind of legitimate. But Brian Bernstein of Rich Product Ventures makes a compelling case for why it doesn't have to work that way. Rich's is an 80-year-old privately held food company doing over $6 billion in revenue. Dozens of manufacturing plants, deep cold chain expertise, and food service and retail distribution across 110 countries. The honest pitch, as Brian puts it, is it's patient capital plus real operational expertise. Cold chain, R&D, food science, supply chain, distribution channels, that most other investors simply can't touch. They started as a generalist food fund, and today they're leaning hard into branded CPG, and they're particularly excited about what's happening in the freezer aisle right now. Brian joins me to break down how corporate venture works when it's done right, what founders should actually be asking before taking strategic money, and where Rich Product Ventures is placing its bets heading into the back half of 2026. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, and investors in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Brian, we're going to hit the ground running here. We've already had a nice chat in pre-recording, so we're going to pull a punch right out of the gate. Corporate venture. It's got a bit of a mixed reputation. Founders worry about strategic agendas, alignment, potentially even slow decision-making. Maybe there are conflicts with a parent. So how does Rich Product Ventures navigate that tension? What do you say to a founder who's wondering whether a corporate VC is the right partner for them?
Yeah, I love it. And we can get into some more of what Rich Products Ventures is and what our parent company is a little later. But I think the concern is definitely legitimate. There's been a lot of corporate venture funds who may have burned companies in the past with false promises or overpromises. And we definitely take that concern seriously. Founders, have heard stuff about corporates wanting to absorb IP or deals dying in committee because the business unit leader that was requiring sign off on it may not sign off. Or it takes forever, or the parent company may become kind of like a de facto competitor. We try to avoid all that and really lay out the fact that we have investment autonomy as a fund. We're not going to our business unit leader and asking for sign off. It's definitely part of our diligence process because they are ultimately experts in the fields that a lot of these businesses are within. So what we do is, up front, we tell the founders directly, we're most valuable when there's strategic overlap. That said, we're not trying to manufacture some sort of strategic agenda that would compromise your independence. We're very upfront that we're not investing to acquire the business or to cap the upside. In most cases, when we're a minority investor, we'll tell them, we're not going to ask for a ROFR, obviously. We're not going to be the likely buyer. We're investing primarily for a financial return and for learnings to bring back to our parent company on some of the trends that are going on in the food world that may be kind of a year or two ahead of where our parent company is today. So really, the honest version of the pitch is if you want patient capital, we invest off the balance sheet. So we're an evergreen fund. We don't have to raise money from LPs. We don't have to get returns in 3 to 5 years like some other funds do in order to raise their next fund. So we bring that patient capital. We're also all operators. So we really bring operational expertise to the table that I think a lot of financial investors may not have or may not have as much of. They may have venture partners around the table, but all of our investing team, the three of us, are all former operators. And I think the right founder for us knows that they're really getting into a long-term relationship. This is a wedding or a marriage, and it's something that they want to make sure that they're aligned with us. And not every strategic investor is right for every corporate, or for every startup. So you got to think about what you're building. Is that aligned with where the expertise is for that corporate venture fund? For instance, Rich's doesn't do anything in the salty snack categories. So while there's a lot of innovation in that space and, everything's being proteinified, it's not necessarily a category where we'd be able to drive a lot of value add from day one. So that's something that, we try to make sure that we have alignment with our investments prior to going into that relationship to figure out how are we going to drive value outside of what a normal financial investor would do.
I want to pull on that last bit because I think it's probably the biggest pro of a corporate venture partner. Every single investor, or certainly growth equity investor in the world, says that their differentiation is their value add. But like you said, your actual operators, you have actual business units. Rich's core business is manufacturing with a specialty in cold chain, dozens of plants, channel distribution through food service, retail in 110 countries. When you invest in a portfolio company, how real is the ability to kind of plug them into that infrastructure or that channel distribution? I imagine every portco is kind of begging to get more help. How do you navigate that?
Yeah, I think our ability to do it is completely real. It's not automatic though, and is really something that develops over time. So um, some of the things that you mentioned, Rich is experts at, whether that's our frozen capabilities. I think it's over 95% of our business today is frozen, and it's been that way for the last 80 years since the business was started. Um, whether it's some of the unique relationships that we have outside of the retail channel. So while a lot of big food or big CPG companies sell every day to your grocery retailers and convenience store chains, they don't necessarily have the relationships in businesses or colleges and universities or food service. So that's something where we think we can help drive value from a channel diversification for some of our portfolio companies. We've got really strong R&D and food science resources, supply chain resources. So there's been multiple occasions where we are able to take some of those resources and think about essentially offering it as a complementary service to help drive value for that business as they're thinking about moving to a new co-man or scaling into a new channel or launching a new business line or a new product. Those are all things that we think we can tap into different parts of the organization to make friendly introductions, not just to hand off a phone number, but we'll sit in on those calls and make sure that our team follows up on it and actually helps these businesses get to their full potential. I think ways that we see fail are when one of these startups, to your point, kind of just doesn't know what they're asking for. So it's kind of hey, can we sign a commercial agreement? We have an ingredient that we're trying to bring to market, but it's maybe still 3 years out. And I think while we'd love to do that, there's got to be an understanding of how big food works. It's a long cycle of innovation and R&D. And we're not just going to sign an offtake agreement because we're an investor in a company, or we're not going to sign a co-man agreement if the economics don't make sense for Riches. So all of those things have to be kept in mind. And, as a result, these are relationships, as I mentioned, that develop over time. So we will invest, we'll figure out ways that we think we can make an immediate impact, find that low-hanging fruit. And then over time, that relationship could deepen, or, if we don't end up finding that commercial relationship, there's always that opportunity down the road. And in the interim, we may act more like a financial investor and an advisor versus truly a strategic partner. I think there's a lot of value, though, to the strategic capabilities that Riches has developed over the 80 years that I think truly differentiate us versus kind of what every other venture fund may offer.
Now, to make all of that a bit more real, you mentioned ingredients. I know you invest in brands as well. What does the surface area of the Rich portfolio look like? And especially if you're able to name a couple of names within the portfolio.
Yeah. So when the fund started, it was started about 8 years ago. And the focus was really anything that touched the food world after the farm. So that included ingredient technology, alternate proteins, software that could be inputs to different parts of the food system, hardware that could help with automation or reducing labor across food service or in manufacturing. And then also direct-to-consumer businesses and brands. as we've seen the food world shift more towards startups and brands that are taking share from the large incumbents, our focus has really shifted more in recent years towards the branded CPG world. So as you mentioned, we've made about 3 or 4 investments in the last 9 months or so into branded CPG companies. A couple of them to mention, one is a company called Evergreen, which is a better for you waffle business, waffle and pancakes. They just came out with protein waffles and pancakes in the freezer aisle. Think of it as a better for you Eggo. Eggo still has 80% market share. We saw a big white space for disruption there. There's been some protein waffle brands or gluten-free waffle brands that have made some inroads, but nothing that's truly just gone after being a good tasting, better for you, clean label waffle. So that's one. Another one that we've invested in recently that we're big fans of is a company called Delicious, which is a frozen novelty business. It's gelato balls that are enrobed in cookie dough and crumbs and in all different flavors. And we saw that as this hitting on this trend of permissible indulgence. So, people, even though they're eating healthier, they still need that sweet at night, or they still want to treat themselves to something that makes them feel good about eating healthy all the rest of the day. So these are handheld 100-calorie bites that are pretty satisfying. And we saw that as a category that had been disrupted by true fruit, but there hadn't really been a ton of other innovation in that space. Drumstick and traditional ice cream pints are still the leader in that frozen novelty category. So we really thought that was one that we could potentially help drive some value in introducing them to maybe food service opportunities, or helping them as they've set up a new manufacturing partner in the U.S. So those are 2 more recent ones, but we're actively investing in new ones that will hopefully be announced in the next few weeks that will be exciting, and ones where we truly see disruption opportunity in the freezer aisle, which is happening, I think, as we speak. We're seeing more activity in the frozen aisle than I think has ever been seen before.
If you're serious about the economics of every order, this one's worth paying attention to. Rocked Aftersell is a leading post-purchase optimization system running from cart to thank you page. Smart checkout offers, one-click upsells, all of it connected, all of it working together. Brands like Hexclad, Jones Road, True Classic are seeing up to 30% revenue per visitor lift without touching their acquisition spend. But here's what the best growth teams are doing in 2026. They're not just squeezing more revenue per order, they're monetizing the real estate they already own. Rocked Thanks turns your confirmation page into a pure profit line with premium, non-competing offers matched by Rock's Brain AI. We're talking 30 cents to 50 cents per order straight to contribution margin. So at 50,000 orders a month, that's up to 25,000 in found profit every month from a page your customers are already landing on. Works on every platform, no contract, launch today. Go to aftersell.com/exclusive to claim your exclusive offer and start unlocking incremental revenue on every order.
And talk a little bit about the stage and maybe round dynamic. Like, what is maybe the size or aging of the brand? Do you like to take the whole round? Do you like to lead? Do you like to follow with a kind of strong lead?
We started out, and this is actually an evolving strategy, so I'm excited to talk about it. We started out as a straight minority follow-on investor, $1 to $3 million checks, and the goal there being have a strong lead come in, lead the round, price it. Ideally, they're priced rounds, although we've definitely participated in notes and safes. But generally, that means we're looking for businesses that are in market or have a clear path to market, have a clear path to strong unit economics, and hopefully this is some of the last money that they have to raise. Understanding that stuff always changes, but we don't want to be super diluted down the road. So that's strategy one, is call it late seed or Series A at a fair price, where our money will both be impactful, but will also have a big enough chunk of the business where it makes sense to really lean in strategically. Over the past few months, we've added a couple new strategies to this that I'm happy to talk with any listeners about if there could be opportunity for us to work together. One of them is more of a venture incubation strategy. So thinking about how we could potentially co-incubate businesses with external entrepreneurs and bring together some Rich's resources and fund it and help structure the business and then grow it outside the four walls of Rich's, but leveraging a lot of Rich's resources. And then two, it would be more on the growth equity side of things. So looking at scaled businesses that maybe haven't raised a ton of venture money prior and could use some venture money to really catalyze growth and continue to scale. So these are normally businesses that are, call it more Series B, Series C, but may not have raised money previously, are either break even or profitable and could really use money to drive marketing and to drive trade spend to hopefully grow further. So those two are newer strategies that we're still working through, but two that we're excited about currently.
It seems like we've had a boom of emerging CPG brands go from 0 to 9 figures in revenue, $1 billion plus valuations. Olipop, Poppy, Siete, Grunes this month. Suja Juices is going public. There's a lot of excitement. F&B and specifically ag went through kind of a hype cycle a few years ago, kind of around the 22, 23 era. Alt protein, vertical farming, meal kits. I'm guess like, how do you balance kind of enthusiasm and we're all in versus like, hey, we've kind of seen the past to wreak some havoc, we need to be wary?
It's definitely a brutal reality that, there was a hype cycle that I think kind of confused, I'd say, novelty with necessity. So a lot of capital went to things that maybe should have never been funded or that were genuinely impressive from a science or an engineering perspective with a lot of great IP, but had no viable path to real cost parity or strong unit economics compared to the incumbent products. And I mean, that's what I think you saw in the plant-based space. A lot of funding went in thinking these were tech companies because there was a lot of tech involved, but ultimately these are all food products that people have to eat in order to drive revenue. So if they don't taste great and if they don't have strong unit economics at price parity, they're likely not viable. So I think, the category in general kind of conflated consumer curiosity with really what would be sustained purchase behavior. So there was a lot of trial of those products, but not a lot of repeat. I think, you mentioned vertical farming. It was a bet on energy costs and labor staying low, and the world went in the other direction. And I think what really the reset clarified for us at Rich Products Ventures is that we definitely want to back companies where the technology could make something cheaper or faster or more reliable, but not just, different. So efficiency is a value prop, not really the novelty there. And I think, as you mentioned, in the CPG space, it is definitely getting a little scary. I think there's some valuations that are now moving past where the products are, and you're kind of paying ahead for growth that is definitely risky for any early stage business. But I think it does validate some of the exits that we're seeing are validating the fact that consumer is a profitable and potentially very value accretive place to be building right now. And we're seeing, there's tons of tailwinds coming from Maha or coming from just broader consumer trends towards healthier eating, where I think there's plenty of white space for new billion-dollar companies to still be created. I think that the key is just, when we're looking at investments now, it has to pass not just the bar of what this pencils out to at Series C scale, but really showing me a path towards strong unit economics with the current round. And maybe margins aren't super impressive today, but there's a clear plan in place to drive significant margin improvement. There's a clear plan in place to go from that $7-8 million of revenue to $20 million in the next year to drive kind of that hockey stick growth that every venture investor is looking for. So I think, in any hype cycle, there is overinflated reality. But I think in the current state of the market, a lot of the tailwinds are justifying some of the valuations that we're seeing because the growth is unlike anything we've seen before. I think there was a McKinsey study today or maybe last week that came out that said, I think it's 35% of growth in the CPG space is now coming from insurgent brands. That's the highest number it's ever been. And big food is looking for growth. So I think more and more big food is going to be acquiring these insurgent brands earlier than they may previously had taken a serious look at them. So I think, the threshold used to be 100 million, 150, 200 million to really get a look. And I think we're seeing some businesses that are showing growth potential and strong unit economics to the point that they could be acquisition targets much earlier. So that may not always be a $1 billion type exit, but there are healthy exits to come in the CPG world because of all the trends and the industry dynamics right now.
Most founders scaling paid media are flying blind. They're handing it off to an agency, watching the invoices go out, and hoping the ROAS numbers mean something, which they usually don't. The brands that actually scale paid sustainably, the ones where the CAC is under control, MUR makes sense, and the contribution margin doesn't disappear at the moment you push spend, those founders understand the machine. That's exactly what e-commerce equation is built for. It's a program for $1 million to $10 million operators who want to own their growth strategy, not outsource it. With it, you get operator-built frameworks for scaling paid, not guru tactics, deep diagnostic work so you can actually understand your data before you spend another dollar, and direct coaching from people who run this at scale. Creative, CAC, MUR, CM, the whole stack in a system you can actually use. It started in Australia, and it's now one of the fastest growing operator programs in the US. Because the fundamentals don't change by geography. Cash efficiency is cash efficiency. So if you're between $1 million and $10 million in revenue and you're tired of paying agencies to learn your business, go check out ecommerceequation.com. And the link is in the show notes.
How do you think about competition? You mentioned waffle and pancake first protein. It seems like everything is, like you alluded to, protein maxing. Everyone's competing on protein per calorie. But with the growth of insurgent brands, there are just so many out there. And what else are you looking for? What kind of defensibility are you looking for within the branded CPG space?
Yeah, I mean it's hard. The number I hear changes all the time, but something like 90% of brands fail within a couple years of getting off the ground. So it's definitely competitive in the space. You can't just compete on brand. Brand is a strong lever to pull, but ultimately you have to win on solving a real need, I'd say. So when we look at products, is it operating in a white space that consumers are looking for products within? Is it solving a need like for Evergreen, for instance? Breakfast is hard for parents. Normally the kids are waking up late. They're running out the door on the way to school. They're looking for something convenient that's also healthy. And that's not something that really existed or exists today. So we really saw that Evergreen was potentially solving a need for a consumer who's looking for better for you products that are convenient and quick to get ready and something you feel good about feeding your kids. So I think that's one way to look at competitive dynamics, is who's solving a need versus just being another Me Too product. I think another competitive lens that we view stuff through is if they have some unfair advantage when it comes to unit economics. So for instance, if someone's managed to bootstrap the business towards having some sort of own manufacturing where they're able to not have to pay co-man fees and tolling costs and able to optimize their own manufacturing to cut down on costs. I think that's one way that people can differentiate and can therefore sell at maybe a slight premium, but not the 2x premium that a lot of better for you premium brands are selling for. I think a third way that I'd want to look at businesses from a competitive lens is this something that there is a clear acquirer for down the road? I know that's somewhat controversial, is building to be acquired versus building to be a strong business independently. And I think it's hard for us to back businesses that don't have clear buyers in the future. And we don't want to just hear Conagra or General Mills will acquire us because they only do so many acquisitions on an annual basis. So you have to, put some thought into who the real potential acquirers are based off who you're going to be a threat to. And then I think the last thing I'd say is, and I probably should have said this first, but from a founder perspective, you're ultimately backing a team. And I think in consumer, as much or more than any other category, having that founder market fit is super important. Having a founder who's obsessed with their product, obsessed with operations, and making sure that their customers are getting the product that they are expecting consistently, with high fill rates, and building that community around the product, I think is a lever that a lot of these founders are using earlier on, not dumping a lot of money into marketing, but actually grassroots community building and connecting directly with the customers versus spending money in inefficient channels. Obviously, there's always going to be the trade spend that has to go into building a brand and driving trial. But I think ultimately that obsessed community of followers and customers is one that is, I think, the biggest differentiator in a competitive marketplace.
Yeah, I'm curious on that specifically. We spend more of our time in the D2C and online world rather than kind of retail and on shelf. And I think something I've noticed more in the last maybe 5 years in particular is that I feel like the majority of upcoming D2C first brands, the founder is more out there on the company socials. They may come with kind of a very small, I'm not talking like influencer-led brands. They may come with a very nascent kind of social following. They're used to that motion, but they are the face of the brand and they're speaking on socials almost every day and audience building along with company building. I'm curious if that happened, when you talk about activating community, like are retail first founders engaging with the community on socials daily, driving awareness, or is it kind of just like you said, it's more trade spend and promos and kind of the typical retail mechanics?
Yeah, I think the most successful brands that we've seen in driving trial do often have a founder-led component, at least in the early days. I think, the categories where we've made a lot of investments within frozen, it's harder to do sampling. It's harder to do trial, by having a sample product out in the store. So I think, building that community online could be a strong way to get people to realize that they have to walk down the freezer aisle, and maybe they haven't walked down the freezer aisle before, and they become a new shopper of this better for you frozen category. So I think, having the founder directly connect with their audience is important. I think there are definitely other ways to go about that, though. As you mentioned, influencer marketing. If you are targeting that space, I'd say just making sure that your influencers and the influencers you're working with truly align with the product that you're selling. I can't tell you how many times I've seen an athlete in a pitch deck and I'm like, what does this athlete have to do with this brand other than that their agent got them to put $25,000 into the business? So, don't rely on having some social media influencer drive success for your brand. It's a tool in your toolbox, but it's not going to be as powerful as having a founder who can resonate with their early community and drive trial, drive awareness, and ultimately repeat, which is the ultimate success metric for any CPG brand is repeat, which drives velocity, and it's the whole flywheel from there.
Most founders treat subscriptions as a marketing tactic. The best ones treat it as a capital structure decision. Here's why that matters. Recurring revenue changes your multiple. It changes how lenders look at you and how acquirers underwrite you, and how much runway you actually have when things get tight. Predictable cash is the asset, not the size of your customer file. Recharge is the subscription platform serious e-commerce operators actually use. It gives you the visibility and control to run subscriptions like a business unit. subscriber behavior, churn management, retention flows. Built for operators who think in contribution margin, not conversion rate. Recharge runs on Shopify, and with it, you can launch and optimize subscriptions fast and convert one-time buys into recurring revenue. Brands like ButcherBox, Harry's, and Ritual are built on it. If you're building something worth acquiring or worth keeping, subscriptions aren't optional. They're your defensibility. Go to getrecharge.com. That's GETRECHARGE.com. This is maybe an incorrect assumption. Maybe it's a controversial question. I'm not sure. But we've had a few investors come on in the last year, and K-shaped economy has come up so much. And specifically, the insight that they've been surprised at how big the TAM is at the top of the K-shape, that you can sell products at 2x, 3x, 5x the median price. Yet the purchasing power is so strong, the repeat and replan is so strong. But I imagine a lot of richest products, you're incredibly strong in QSR and restaurant chains, and probably maybe not at that super high end part of the K-shaped economy. So I'm curious, where do you spend time, maybe demographically?
Yeah, I like to view any brand through a test that, or a test that I've learned from Adam Spriggs at the Angel Group, he's from Ohio, from Toledo, and he views every brand that they invest in through the lens of the Toledo test. And the Toledo test basically says, if the brand is not going to sell at a Kroger in or around Toledo, Ohio, you're probably not going to scale nationally to the point that you're going to drive a significant exit. Now, to your point, there's the K-shaped economy that will drive premium purchases in the early days, but ultimately the halls of Expo West are not what the streets of Ohio look like. And I think, there's definitely value to ultra premium brands. I think specifically in personal care and cosmetics, you can have brands that have incredibly high margins. You don't need to sell that many of them. And you can drive a significant business with that. Now, where I struggle more is brands in the food world that are selling for 2-3 times the leading brand price. While that's good early on, hopefully your unit economics as they scale allow you to leverage trade spend to bring price down, to be more approachable, to drive trial, and ultimately allow you to expand distribution nationally to the point that you're not just 1% household penetration rate, you're reaching that 10, 15, 20% household penetration rate where you become the household brand. And I think that's something Olipop has done well, for instance, right? They started out as a super premium. It was $3.50, $4 for a can of their sodas, but ultimately people like better for you sodas across the country, and they've been able to bring price down over time as they've gotten further scale. And it's something where I now, at least as a consumer, am having an Olipop every day. It's become part of my ritual of sorts. And whether it's because I like the functional benefits of it, or I just resonate with the brand, it's something that I think has crossed that chasm from the Erewhons of the world into Kroger and Publix, and it's resonating with a consumer base that crosses demographics. I'd say you can't solve for everyone at once, though. So I think it's important to be focused early on, be focused on that target demographic. So if your demographic is 25 to 35-year-old women, go after them, build a deep community, deep following, and then figure out how to expand from there, either through new product lines, new SKUs, or through marketing, once you conquer that initial target market.
Brian, for your food or packaged CPG brands, for the ones that are listening, that are building in that space, is there a marketing tactic, something operationally, potentially a novel channel or a piece of tech that's working especially well for them right now?
Yeah, I think it's interesting. We're seeing more and more use of AI in operations of food businesses that are allowing businesses to scale with fewer people than they've ever needed. We've spoken to some businesses recently that are getting to $30-40 million of revenue with maybe 3 or 4 people full time in the business. And that's something that without the use of some of these AI demand forecasting or procurement optimization or production scheduling or trade spend management tools, that would have required, each of those would have required at least one full-time person to manage those aspects of the business. So I think businesses that are truly leaning into the use of various AI tools to drive marketing, to drive operations, to drive product development, I think we're seeing a lot of success in those brands and interest in those brands from the investor side. I think two would be figuring out how to efficiently spend marketing dollars. For a while, as you mentioned earlier, during the boom of food tech, venture money was just going straight into marketing and wasn't being spent efficiently. I worked at Blue Apron in a past life, and I think that's the best case study ever in inefficient marketing, right? We were acquiring customers that never paid themselves off. And that gets you to be a big business pretty quickly, but it doesn't create a lasting business that is one that drives acquisitions and strong exits. So I think efficient marketing spend, and then I'd say overall as a theme, brands that are able to be cash efficient, to extend runways, improve margins, without always thinking about needing to raise the next round of fundraising. I think those are the brands that we see succeed. The brands that, raise 5 million and then are back in market 3 months later because they're burning $1 million a month and they're always having to think about raising the next fundraise at a higher valuation are the ones that are thinking too near term and not thinking about building a brand that will leave a legacy and potentially be acquired long term. I mean, I think not to say that Riches doesn't have its faults, but Riches has been around for over 80 years. It's been built as a private business. It's now over $6 billion in revenue. And it's a business that, has focus on profitability and capital efficiency and hiring when there's a need versus hiring ahead of time. I think that's one piece of advice we always give to founders is hire when it's painful, not when, it's more opportunistic, and wait until it's maybe a little too late to hire. So that's kind of some tactics we're seeing working in market. I think one last piece is we are seeing more focus on channel diversification as an opportunity to grow your revenue. So one area I mentioned earlier where Riches is strong is within food service. A lot of early stage brands, food service may be an afterthought, but it's a long sales cycle. It's hard to get in. Sometimes there's pricing pressure, but a lot of times there's also big opportunities from an LTV perspective. If you land in a chain and you create a sticky relationship where that one food service relationship could be worth 10 retailer relationships. So thinking about omni-channel, not just from online and retail, but also thinking about food service or colleges and universities or business and institution, where there's other categories with real spending power to potentially drive growth for brands.
Yeah, super interesting. Brian, as we head towards a wrap, is there anything that you're seeking from listeners? You mentioned the co-incubating earlier, brands, operators, other collaborators.
Yeah, I mean, I'd love to talk to any founders who think they're building something interesting where Riches could bring value. We don't require this strategic relationship by any means, but if there's a 1 + 1 = 3 opportunity that you think you may be bringing to the table, we'd love to chat. I'd also say, to that point on the venture incubation side, if you're a founder who's got an idea and may want to not go the traditional route of having to raise venture money and then build a business independent, if there could be a co-incubation opportunity with you, definitely reach out. And if there's clear enough synergies and a big enough opportunity, it could be one that we'd love exploring. And then I think, if anyone sees opportunities for us from an investment perspective as well. We are active in the early stage investing world. So if we're not the right partner, I'm always happy to make introductions to other potential investors in my network as well. So I think all of those are ways we could potentially do stuff together. Feel free to reach out over LinkedIn. I think that's generally the best way to get in touch with me. Or on the Rich Products Ventures website, we have a way for you to submit kind of directly to the website for our review. So those are a couple channels, but always happy to chat given the right opportunity.
Brian, thanks so much for coming on and sharing all that knowledge. And yeah, really excited for next time.
Awesome. Thanks, Fan.